Thank you very much for having the opportunity to talk about this particular topic. It's an area in which I've been working, not a lot, but I've actually written a few papers on REMIT and market transparency, and I'm afraid I've taken a rather critical view of some of the regulations, and that might sort of shine through what I'm going to say. But my task is to try to make sense of the term market abuse, which is not a term that's regularly being used within economics, but I have to translate it somehow into to make sense of it in economic terms. So essentially, the problem I'm going to talk about is what is REMIT really trying to solve? What are we trying to achieve with this set of regulations? And I'm actually going to spend a part of that talking about something that REMIT is, in my understanding, not trying to solve, namely market power problem. However, the problem that REMIT is trying to solve is closely related to market power, and sometimes could even be confused with market power. So, but it's something different, and it's called market abuse. The market power issue has to do with players, market participants, either individually or together moving prices to their own advantage. So they're somehow affecting the market fundamentals. It could be the price itself directly, or it could be their supply and demand in such a way as to manipulate the price in order to make money from it. And from an economic or from an efficiency point of view, that's unfortunate because it distorts resource allocation, as economists tend to see. Resources are not being used in the most economically efficient way when firms exercise, or market participants exercise market power. And hence, governments in various ways intervene, either regulating the price directly or in other ways trying to undermine the market power of market participants. So this is a well-defined concept in economics, well-researched and reasonably well understood. Market abuse is closely related, but it's not the same. It has to do with information. It's either that someone has some information that other people don't have, and they trade on that and benefit from it. Or it could be the other way around, that they're trying to give people trying to feed them with information that's not correct in such a way that they can benefit from it again. So it has to do with prices, but it works through not market fundamentals as such, but information about the market, true or false. And the problem here is not so much distortion of resource allocation, as we shall see. There's a lot of talk about fairness when it comes to market abuse. But from an economic point of view, the real problem seems to be that it undermines the trust and hence the working of markets. People don't want to trade on a market where they're afraid of being fooled, so to speak, or making a bad trade. So again, governments tend to intervene, and in this case, the intervention is aiming at creating trust in markets, trying to convince people that you can trade safely on this market, you will get a fair deal. So, but first I will talk about market power, just to make that clear. For some of you this is old news, but still I'll spend a little bit of time to make clear that so that we all know exactly what I'm talking about. So market power is really manipulation of market price. It could come in many forms. It could be by raising entry barriers or fiddling with contracts. It could come in many forms, but essentially it's driving the price in the direction that you want it. If you're a seller, you want the price up. You want a higher price. And the way to do it is to either charge a high price or to limit your supply in order to drive the price up. If you're a buyer, on the other hand, you want a low price. So you do the exact opposite. Either you offer a low price or you limit your demand in order to drive the market price down. This could happen. There could be individual players who have market power if you're sufficiently big. in particular if you're a monopolist, so you're the only seller of a particular product, then you will tend to have market power. The price is effectively being determined by you. Or you could be on the other side of the market, you could be a monopsonist, the only buyer of a product. So there are many sellers, but you're the only buyer, and hence you effectively determine the price. Now there are many in between these extremes, monopoly on the one hand and what economists call perfect competition on the other. There are various forms of imperfect competition, where individual players are big enough, not to control the market completely, but big enough to be able to drive the price. And that's typically called imperfect competition. It comes in many versions. In competition policy, we're often talking about having a dominant position, being dominant, which means being, in economist terms, being big enough to affect price. It could be individual players with market power, but it could also be that players get together and exercise. Each of them might be too small to exercise market power, but together they can exercise market power. So we're talking about collusion or cartels. That's typically not allowed, with some exceptions, but generally that's not allowed. We could also have what economists call tacit collusion. That's when players are not really colluding as such, but the market outcome is as if they had been colluding. So this is what market power is. What is the problem? Well, I've illustrated this with the famous monopoly illustration. This is supposed to illustrate a particular market, and there's a single seller here, and there's some demand. So there are a number of buyers, and demand depends on price. So demand, the demand curve is downward sloping. The higher is the price, the smaller is demand. And then the monopolist has some costs, some unit costs, which I've assumed is being constant, independent of how much the monopolist produces. And then the monopolist will now have to trade off. He would like to sell a lot. On the other hand, he also wants a high price. So he has to balance these two forces. And you can show that, in fact, what I've termed here monopoly output and monopoly price is exactly the combination of price and output that maximizes his profits. The point is, however, if we compare it to what would be sort of the ideal outcome, which I've called the competitive outcome, competitive output is too small and price is too high. And that's causing a number of problems from an economic efficiency point of view. Firstly, there's too little trade, in a sense. You see, the monopoly output is smaller than the competitive output. So there are people out there who will be willing to pay the cost. They're willing to pay a price that's higher than the cost, but then don't get to buy. Because if the monopolist were to reach these players as well, he would have to reduce his price, and he doesn't want to do that because then he loses profits overall. So that's sometimes called a deadweight loss, the fact that there's too little trade. Secondly, the price is giving the wrong signal to people. It's telling people that this is a really expensive good. You have to be careful. You don't have to use it very much because it's very expensive. You should spend your money on something different. And that's the wrong signal because the price is too high compared to the cost. It's really not such an expensive good. It's only that the monopolist is fooled with the price. Then there is the potential efficiency that the monopolist, since he has such a high price and such a high profit, he doesn't necessarily have to work so hard to keep his costs down. So it might be tempting to, or the costs might tend to slide up, and so meaning that the production becomes inefficient. And finally, there is a potential problem. It's not an efficiency problem, but in this case, the monopolist wins and the buyers lose. So there's redistribution. Whether this is good or bad depends on our view about the monopolist on the one hand and the buyers on the other. Sometimes we think that if the monopolist is a big, fat monopolist, big firm, then this is bad, and consumers are small sort of households or something. Then if this was an electricity generator, for example, this would be bad, because we would tend to favor the household consumers. On the other hand, if the monopolist was a cartel of small farmers, say, and the buyers were big retailers, then we might think that this is actually a good idea. So that depends, but there's redistribution. So market power is a problem because it distorts resource allocation. Resources are not being used in the best way. There's too little trade. Price signals are being distorted. There could be cost efficiency. There's a famous quote in the economics literature that the best of all monopoly profits is a quiet life, due to the economist Hicks, meaning that when you have monopoly or monopsony or market power, there tends to be inefficiency also. And finally, there's redistribution. And I put a parenthesis around that because partly it's not an efficiency issue, and secondly, it's not obvious whether it's a problem or not. That depends on who are on the two sides of the market. It's a big enough problem, market power, that governments in various ways try to get rid of it. And they do it in what I've termed two principally different ways. They have ex-ante intervention, which meaning that they do something sort of before the market opens, in a sense, to ensure that the market works and there isn't market power. And one intervention is typically to regulate the price, which we know from various parts of the electricity industry, for example, or the gas industry. Or they could be ex-post intervention. That's, in this case, typically called competition policy. That's when you realize that the price has become too high, or somebody has abused its dominant position, as is said, then there's some sort of penalty. And merger control is somewhere in between. You could think of it as an ex-post intervention, but you could also think of it as a structural ex-ante intervention. So this is market power. This is being big, either alone or together, driving the price. And that's not really what REMIT is about. Here is what REMIT is about. So this I've taken from the REMIT regulation. And it defines, well, this is not the exact, in the regulation itself there is a more precise definition, but this sums up what we're talking about. So we're talking about two things. Market abuse is on the one hand insider trading, and on the other side market manipulation. Inside information is probably the easier part. It means that you have some sort of informational benefit. You know something that other people don't know. And what you know has an implication for the market price. If other people knew what you knew, price would be different. They would not want to trade at the existing price. So if you trade on that information, you obtain a benefit in a sense. The price is different from what it would have been if everybody knew what you know. Manipulation is something different. That's, in a sense, trying to affect the price through false information, so to speak. If you look at the definition, it comes very close to market power. You say, see, it's artificially cause prices to be at a level not justified by market forces. It sounds very much like sort of imperfect competition, right? Sort of, in fact, it's not entirely clear what it means until you start reading. Well, maybe other people understand what this meant. When you start reading about the various detailed points, it becomes a little bit clearer. But if you look at the exact definition, it's very, very close. It seems to have a ring of market power anyway. But that's not, I think, what it's about. It really is about trying to convince people of something that's not true, lying to them or feeding them information, or in various ways trying to give them the impression that price should be different from what it is, and then make them trade on that different price. You also see that when you look at the last part, which is talking about examples of market manipulation, you see again we are very close to something that looks like market power. We're talking about fixing the price. And another interesting thing, which is very different from the market power idea, is that we're talking about unfair trading conditions. So we're talking about something here which has to do with fairness, which is something economists have a hard time understanding what it is. I mean, fairness is in the eye of the beholder, right? So we all have our ideas of what is fair, but we don't necessarily agree, and there certainly isn't a good economic theory to tell us what is fair and what is not. Now, let me point you to a fundamental paradox and a fundamental difficulty, at least to an economist, from market abuse. Now, trade, or why do we have trade, or why do we have markets in the first place? Well, we have markets because people have different views, or different costs and benefits, different views about costs and benefits, and that's why they trade. The reason I want to sell you something is because you're willing to pay a higher price than what I think my good is worth. If we agreed on what it was worth, there was no point in trading, right? It's only because we have different conceptions of what something is worth that we are willing to trade, and that's the reason why we set up markets, in order to have people trade on this basis. So the whole point, in a sense, of a market is that the starting point is different. That's the rationale for a market. Secondly, the price mechanism is a way of aggregating information. It's a mechanism for telling you that something is cheap or something is expensive. And that the reason it's cheap is that there's a lot of it, so you can have some you too. Or if it's expensive, there's very little of it. It's valuable. So the price mechanism, or the way a market works and the way prices forms, gives you information about what information different people have. It gives you information about scarcity and abundance, and individual people's information about that, how they view this particular good. So paradoxically, in a sense, a market is, at least when a market works, it is a means, or it's a way of reducing market abuse. So it's a little bit of a paradox that we're talking about market abuse, at least clearly markets can be abused in the sense we've just seen, but really the problem is that markets, if the market worked as intended, then it would eliminate market abuse. So what is the purpose of REMIT? Well, I've singled out a few words. I think, to me, at least from an economic point of view, the essence is the confidence word. Is the point of dealing with this, with insider trading and market manipulation, is not because there are problems in themselves, although many people might think so, but from an economic efficiency point of view, the problem is that it undermines confidence in marketplaces, and hence people don't participate in these markets. But you see there are other words here as well, like fair, fairness. That's a very tricky, it's very tricky to build regulation upon fairness, and I'm not sure it's really meant. That's really what it's meant. You see competitive interplay, but then again we're in the area of market power and competition policy and things like that, which I think is a different issue. And then finally there's something about you shouldn't really profit from either having information that other people don't have, or, which is the whole rationale for a market, so it's a little bit strange, or misleading people, which is again a fairness issue. So a few words about fairness first. Now, if somebody has some information that in fact there's more water around in the reservoirs. I come from Norway, so this is how we produce electricity. So I know, in fact, that I have a lot of water. So I know electricity prices are going to be low, but I haven't told anybody. So and the price now is quite high. So I'm going to sell a lot of my electricity at this high price, knowing that the price is going to be lower in the future. If everybody else knew that, they wouldn't trade with me, not at least at this price. And after the fact, when they realize, oh, this is why the guy was willing to sell all this electricity, because he knew it would be cheap, they would be fooled. Now, you could feel sorry for them. They could have gotten a better deal, but they were still willing to trade. So we were just shifting profits around. Somebody gained and somebody lost, compared to what they would have gotten if the price was different. And you can think that that is unfair. And you can think that this is not the way people should trade. But from an efficiency point of view, it's not really. You have to take a stand. Maybe it was a poor little or a bunch of poor small electricity producers that were just happy and got a high price. It could be good. So this, at least from an efficiency point of view, is not really a concern. We might think it's unfair, but that's another issue. And I don't think the regulation is really about fairness, although there's a lot of talk about fairness. That's not really the point. So what is the efficiency problem? Well, the efficiency problem is that if you go to the marketplace and you buy or you sell something at the price, and you afterwards discover that that price was manipulated, and in fact, if you wouldn't have traded at that price if you knew what the price really should have been, or you would have traded somewhere else where you could get a better price if you knew that the price here was actually wrong. Then you might find that this is not a marketplace where you want to be. So the efficiency problem is that if there is market abuse, or there is a risk of market abuse, people don't want to participate in the market. And that's costly. Now, I pointed out here that if this is a problem, that people don't want to trade on a marketplace, somebody will want to do something about it, in particular the people who run the marketplace. So this is a problem you find in financial markets typically, for example, stock exchanges. And all stock exchanges have rules about how people should behave. Not because they're worried about fairness and things like that, but they're worried that people won't trade on the stock exchange if they are afraid of being fooled, right? So there's no government regulation. It's the marketplace in itself who sets up rules in order to attract people. Come to my marketplace, you will not be fooled, you will get a fair deal. Nord Pool, this is the one I know the best, has rules like that. So if you want to become a member of Nord Pool, you have to sign an agreement saying that you abide by certain rules. And Nord Pool will investigate that you behave, that you don't trade on inside information, you give that information to the market, and you don't manipulate the price by giving out false information. And but from an overall perspective, from an efficiency point of view, there are costs of people not trading on a market. There's too little trade, so that's very similar to the market power problem. Also, people might go somewhere else. They might trade on OTC markets if they don't trust the power exchange. And on the OTC market, there's much more work to find a counterparty and transaction costs and so on. So that market is typically less efficient, at least under certain circumstances. Or they might do other things to avoid using the market. They might, for example, integrate vertically to be so as not to have to trade on the market, but just have it as an internal trade instead. Or they might decide not to hedge and be exposed to risk because they don't trust the financial products. So that's the efficiency costs we're trying to. So when is this a problem? Well, I've listed a few types of markets where it's likely that this is going to be a problem. Concentrated markets, that's very close to the market power issue. Thin markets, where people very infrequently trade, that's again something where it's very close to market power. Where there's direct matching rather than a single market price. If you compare OTC to a power exchange, if you have a power exchange, you pool all the bids and offers and create one price. It's much more difficult to affect the price than if you're trading one-to-one. And if people are unprofessional in experience, they're more likely to be fooled. And if you trade for speculation, because then the value of your good is really what you can sell it for or buy it for at a later date. And that, of course, is driven by market price. So intervention. How do we solve this problem? Well, the REMIT is solving all the problem is partly the ex-post intervention. There will be various penalties if you don't behave. And there will be also some ex-ante intervention, namely rules on there's certain information that you have to give to the market. But in fact, maybe there are other measures that are more important in order to get markets to work. For example, establishing marketplaces in the first place. Fostering market participation. Make sure that people want to participate in the markets. And, for example, ban vertical or introduce vertical separation in order to force people to go on the market rather than to trade internally. And there is, of course, now the regulation is there, but there's still a question of how it should be enforced in practice. I have to say a few words about market monitoring. I know that's not really my task, but I've been involved in market monitoring myself. I was a member of the Dutch Electricity Market Surveillance Committee when it was in operation a few years ago. And essentially, the point I want to make is that you're taking on a Herculean task. If you think you're amassing enormous amounts of information, and you might think that this will be enough to ensure that you can see if people do these things they shouldn't do, insider trading and market manipulation. I can tell you that's not true. What you can do, and what is typically done in such markets where this is market abuse is a problem, is you can have rules for what sort of information people should give to the market, and that's relatively easy to check. Capacity, if they have to take their plant out and things like that. That's something you can do. But to detect what is going on is very, very hard to do. So in my view, you can do fairly simple market monitoring, that's sufficient. But what you really need, and fortunately the REMIT regulations give you that, is strong powers to investigate when you think there's a certain problem. That's very important. That was something we struggled with, for example, in the Dutch Market Surveillance Committee, that when we thought we saw something that was not quite right, we couldn't get the data we needed in order to investigate. For example, cost data and things like that. So, to conclude, the merit of REMIT is, in my view, or from an economic point of view, I think I would say, is to creating trust in markets. That's what it is about. And that's a problem we know from other markets. I'm not sure this is really a problem in all parts of electricity and gas markets or energy markets, but in certain markets it certainly is, and particularly for financial markets. So, and the most important part of the regulation, in my view, is that you have very clear rules about what sort of information should be made publicly available. The insider trading part of the regulation. Market monitoring, on the other hand, I don't think you should be too optimistic. Of course, you should do it as well as you can, but you should have realistic ambitions for what you can achieve. And a point I always make, trying to regulate conduct, how people behave, cannot substitute for regulation structure. That is, to ensure that the market has a structure that's conducive to efficient functioning, that is competitive.